Welcome in Tom Lee. He is FundStrat's head of research, as I said, right there at Post 9. It's good to see you.
Great to see you, Scott.
So you think we're going to 7,300 on the S&P in the near term?
Yeah.
So are we witnessing this slow turnaround for stocks to get back on track? What do you think?
Yeah, I think stocks took some hits. Partly was a software downturn, and then this rotation out of the Mag 7 armies into the bullet makers for AI, and a general sort of risk off as gold surged. But the earnings have been delivered solidly. We've been getting good economic reports, and I think positioning has gotten risk off enough that we can sort of climb maybe in a labored way towards 7,300.
Hey, how about that? Do you think, we talked about this at halftime today, are we appreciating enough how strong earnings season has been?
I think this haven't reflected that because we've had a huge beat, a large percentage of companies beating. It has shown up, I guess, in small caps, but to me...
Yeah, but I mean, you know what I mean? It's like, if you said we were going to do double-digit earnings growth, and that would be a key pillar of the narrative as to why stocks were going to continue to go higher, and then we had all this volatile chop, and we're not sure now where we're going. You just said, well, if we're going to do that kind of earnings growth, we're going to be just fine.
Yeah. I mean, there's this old adage that it takes a whole lot of E to offset PE, meaning like, you're right, the earnings have been good, but things that have affected multiples are what's causing the market to come in. The AI, a new Fed chair, potential war. So you're right. I think the fundamental anchoring is actually good. So that means stocks eventually kind of re-anchor to that and we go higher.
So you say there are three key trades: rotation back to the Mag 7, the IGV bottoms, that's software, and crypto bottoms. But you're not suggesting that those three items have happened, are you?
Not yet, but we're maybe 90% of the way through that because I've seen some of the positioning data. So we know on for instance, prime brokerage, Goldman data, software ownership is like multi-decade lows. And then we know that the Mag 7 have gotten cheaper than the bullet makers, which has never happened in 10 years. They're 3 PE points discount. And then, of course, on the crypto side, we've already gotten to drawdowns that are basically 80% of what's been in past crypto winters. So I think those are setting up to be really big trades. Maybe they've led the market. So they bottom first and they'll start to rally even if the market's peaking.
Does Nvidia earnings 1 week from today hold the key to the whole thing? Just given the fears about AI and the spend. And we need to get the results. We need to hear from Jensen.
I mean, that could set the bottom because, if you look at the software index, this is like the 8th week of a pretty severe downturn. So next week, as you know, sometimes 9 is a big number, turning point. That could mark the bottom for software.
Market strategist at Jefferies. David, it's great to see you. I mean, is it bad? I kind of want to talk trade deficit a little bit. Was that just a 1 month aberration? What's going on here?
I think, look, I've never gotten very excited about 1 month or even 3 months of data. I think you need to see the trend, and the trend has been that trade has been our friend. These trade deficits have been coming down. Net exports have been a large positive contributor to GDP, which is still looking like it's running at close to 3%. So I wouldn't get too bent out of shape with the volatility, and I think a lot of trade supply lines are just moving in crazy directions because of all of the trading changes that we've had since Liberation Day. So trading rule changes. So I'm not thinking there's some sort of major trend toward deficits coming anytime soon.
David, I always like your take because you're so good on what matters and what doesn't, and that's always an important thing, keeping your eye out on the prize. I would point out, though, that I did some numbers this morning, and I prepared a chart which is going to show that after all the sturm and drag about tariffs, the trade deficit is largely unchanged year over year. And that bothers me a little bit because I think what we've done is shifted the trade, raising the price and shifted the trade. There it is. You can see there, folks, compared to 25, it's a little bit smaller. The trend, as David said, is down towards the end of the month. What happened, according to my calculations, David, is importers imported about 2/3 of a month of imports, January, February, March, and then they kind of let it run down a bit. So that's where we're at right now. I guess I ask you this question, which is overall on the economy, how much are the trade deficits are the tariffs going to matter in 26?
Steve, I think a lot of the economic Armageddon on the inflation side as well as on the growth side have actually not played out over the last 10 months. We're now sitting with a CPI at 2.4%, basically where it was at the April levels, which were some of the lows of the post-COVID period. So since the surge after 2021-22, the post-COVID inflation surge. So I think that's proven to be a big miss by the economics community. And this idea that it was the end of global trade. Remember, we were going to go into deglobalization and nobody was going to trade with each other and everybody was freaking out. And here we are with numbers that really aren't that sort of different, although the trends are working the way I think you thought they would, which is there is some reshoring. It's happening slowly. There is some positive signs that we are taking in revenues on the trade side, and that is contributing to a budget deficit to GDP ratio that's now down to 5.7%, something a lot of people have missed, Steve. It was well over 7% prior to the Trump administration taking over. So there are all these variables we have to take into account, but in general, I think the sort of Armageddon idea that everybody subscribed to in April, May, and got themselves very bent out of shape about, with the exception of a few, is just not played out the way many had thought.
I totally saw that on the deficit. That's why I was actually talking about the trade deficit too, David. But what was interesting in wanting to be like, hey, this is an improvement, is all the projections, even for this year, are still, they're not a full improvement, and then they kind of get worse very quickly. But maybe you would take issue with those projections. But even places like Strategas would kind of say we're going from 5.7 to like 6.2, like that this was more of a one. I don't know if there's anything more hopeful you can tell us. I want to hear a story that says we're going to 5, and then we're going to 4, and then we're going to 3, and then we're, and that just doesn't seem to be in the cards.
Well, remember, I think our primary deficits are only in the 2s, right? The low 2s. So a lot of it is interest expense, and a lot of it will depend on your interest rate views and how the Treasury decides to issue. So if there's any changes, if the administration tries to go for more short-term issuance over long-term issuance and things like that. So I think there's a lot of variables that could be at play here, but we've had a Secretary of the Treasury that's made it a goal of his to drive that number down, and he's been successful in his first year, highly successful. I think fading him at this stage would be a mistake.